Disclaimer.
Hi, it's AG, your favorite silver analyst. You're scrolling through financial news on a Tuesday afternoon, and you see silver jumped 7% in a single trading session. Your first thought? Probably just another volatile day in the commodities market. But what if I told you that while you were seeing one price on your screen, traders in Shanghai were paying $19 more for the exact same metal, and your local coin dealer was charging $30 above what the exchange said silver was worth? This isn't a glitch. This isn't temporary. And this is exactly what happened on January 26th. Now, before you click away thinking this is another "the sky is falling" video, let me be crystal clear about something. This video comes with a disclaimer that actually matters. I'm not a financial advisor. Nothing I say here is investment advice. We're going to look at data, examine different perspectives, and help you understand what professional analysts are debating right now. What you do with that information is entirely your decision, and you should absolutely consult with licensed professionals before making any financial moves. But here's what you deserve to know. Something unusual is happening in our silver market, and the explanations you're hearing don't quite add up. Let me show you what I mean. On that Tuesday, silver's price movement wasn't just large. According to standard statistical models, it represented what analysts call a 5 sigma event. Now, I know that sounds like technical jargon, so let me put it in perspective. Events like this, based on normal market behavior, should happen roughly once every 3,000 years. Yet we've seen multiple sigma events in precious metals just in the past few months. Think about what that actually means. Either we're living through the most statistically improbable period in financial history, or the models we're using to understand these markets are missing something fundamental about what's really happening. And that brings us to those 3 different prices I mentioned. You log into your brokerage account and you see silver trading at around $32 per ounce. That's the COMEX price, the official exchange price that everyone quotes on financial news. But here's where things get interesting. Pull up the Shanghai Futures Exchange at the same moment, and you'll see silver trading at a persistent premium, sometimes $15 to $20 higher. Then call your local precious metals dealer, and they'll quote you another $5 to $10 above even that for physical delivery. 3 prices, same metal, same moment in time. Now, I know what some of you are thinking. Regional price differences happen all the time, right? Shipping costs, local demand, nothing to see here. And you know what? That's actually one of the explanations being offered by mainstream analysts, and we're going to examine that perspective fairly because it might be correct. But ask yourself this question. If silver is really worth $32, why would anyone pay $47 for it? And more importantly, why has this gap been widening rather than closing? The term floating around in precious metal circles is the Great Divorce. It's the idea that paper silver, the contracts and derivatives traded on exchanges, is separating from physical silver, the actual metal you can hold in your hand. Whether you believe that theory or not, the price divergence is mathematically real and easily verifiable. Let me make this personal for a second. Imagine you're planning a vacation and you check flight prices online. The airline's website says $200. But when you try to book, you discover that tickets are only available through a third party at $300. And when you get to the airport, they tell you the actual boarding price is $400. You'd probably ask some serious questions about what's going on with that airline. That's essentially what we're seeing in silver, except the price gaps are proportionally much larger. Now, the important question isn't just that these gaps exist. The important question is why they exist and what they tell us about the underlying market structure. And that's where experts genuinely disagree. Some analysts, particularly those focused on physical precious metals, interpret these spreads as evidence of stress in the delivery system. Their argument goes like this. If you can't get physical metal at the paper price, then the paper price isn't real. It's simply a number on a screen that does not reflect the actual supply and demand for physical silver. On the other side, mainstream financial analysts offer a different interpretation. They point out that futures markets have always had basis spreads, that regional premiums reflect local supply and demand dynamics, and that these gaps, while elevated, have existed before without indicating systemic breakdown. In their view, this is market volatility, not market failure. So who's right? Honestly, I don't have a crystal ball, and neither does anyone else. But what I can do is show you the data that both sides are looking at and help you understand why this debate matters for your financial future, even if you never buy an ounce of silver in your life. Because here's the thing that should grab your attention regardless of which camp you fall into. The silver market isn't some isolated corner of the financial system. It's deeply connected to our monetary system, to industrial production, to banking operations, and to how institutional investors manage risk. When something breaks in silver, it's often a canary in the coal mine for broader market stress. The last time we saw premiums spike this high was March 2020, right before the Federal Reserve had to inject trillions into the financial system. The time before that was 2008. And we all know how that story ended. Now, does correlation equal causation? No, but it does mean we should probably pay attention. Let me give you another data point that's verifiable and important. According to the most recent COMEX warehouse reports, the amount of silver registered for delivery, meaning actually available to fulfill contracts, has declined substantially over the past 18 months. At the same time, the number of paper ounces traded has increased. Whether you interpret this as a problem or just normal market function depends on your perspective, but the numbers themselves aren't in dispute. The World Silver Institute reports that industrial demand for silver has been rising steadily. Solar panels, electric vehicles, electronics, 5G infrastructure, all of these technologies use significant amounts of silver. Meanwhile, mine production has been relatively flat. Basic economics tells us that rising demand plus flat supply should equal higher prices, yet silver remains far below its inflation-adjusted highs from the 1980s. So what gives? Why isn't basic supply and demand working the way we learned in economics class? That's the trillion-dollar question. And it's why thousands of investors, from retail traders to hedge fund managers, are suddenly paying very close attention to a metal that most people only think about when they're looking at jewelry. Some believe we're watching the early stages of a supply squeeze. Others think this is just normal market noise amplified by social media hype. A third group argues that central bank policies and currency debasement are creating distortions across all hard assets, and silver is just one manifestation of that broader trend. All three of these perspectives have smart people behind them, all three have data to support their position, and all three could be partially right. What you won't get from me is certainty about which scenario plays out. What you will get is the information you need to understand what's happening, why it matters, and how to think about it in the context of your own financial situation. Before we dive deeper into the data, I want you to understand something important about how we're going to approach this. I'm not here to sell you silver. I'm not here to tell you that you must buy, that you must sell, or that you must do anything. I'm here to help you understand a market phenomenon that is generating a lot of heat, but not a lot of light. And trust me, by the time we're done, you're going to understand why some of the smartest investors in the world are losing sleep over a metal that costs less than your monthly cell phone bill per ounce. So let's roll up our sleeves and look at what the data actually shows, starting with the documents and reports that Wall Street doesn't necessarily want you reading too carefully. Here's something most people don't realize about financial markets. The real story is never in the price charts. The price is just the headline. The real story lives in the footnotes, the delivery reports, the warehouse receipts, and the obscure data releases that come out at 4 in the afternoon when everyone's already checked out for the day. So let's talk about silver lease rates, because this is where things get genuinely fascinating. Right now, according to the London Bullion Market Association, silver lease rates are hovering around 8%. Now, if you're not familiar with lease rates, let me explain what this number actually means and why it matters to you, even if you've never leased an ounce of silver in your life. A lease rate is essentially what it costs to borrow physical metal. Banks and institutions that need silver for delivery or industrial purposes can lease it rather than buying it outright. Under normal conditions, lease rates are minimal, maybe 1 or 2%, because silver is considered abundant and easy to source. But 8%? That's not normal. That's expensive. Really expensive. Think about it this way. If you needed to borrow money for 30 days and someone charged you an 8% monthly rate, you'd immediately ask, what's wrong with your credit, or what's wrong with the lending market? The same logic applies here. High lease rates signal that physical silver is either scarce, in high demand, or both. Now, here's where the interpretation splits. Some analysts look at 8% lease rates and see a flashing red alarm. In their view, this proves that the major banks and bullion dealers are scrambling to find physical metal to cover delivery obligations. They're literally paying 8% per year just to borrow something they're supposed to have in abundance. The counterargument from mainstream analysts goes like this. Lease rates fluctuate based on short-term demand, and elevated rates simply reflect temporary tightness, not systemic failure. They point out that lease rates have spiked before during periods of volatility and subsequently normalized. Both perspectives are looking at the same number. Both have logical reasoning. So how do we figure out who's closer to the truth? Well, let's add another piece of the puzzle, the COMEX delivery data. Every month, the COMEX releases detailed reports on how much silver is in their warehouses, how much is registered for delivery, and how much is actually being delivered against futures contracts. These reports are public, they're verifiable, and they tell us a lot about what's happening beneath the surface. According to the most recent data, and you can verify this yourself on the CME Group website, the registered silver available for immediate delivery has declined significantly over the past year. We're talking about a drop from over 120 million ounces to under 80 million ounces. That's roughly a 35% decline in available inventory. At the same time, the number of open contracts, which represents claims on future silver delivery, has remained elevated. This creates what some analysts call the paper-to-physical ratio. For every ounce of registered physical silver, there are multiple paper claims against it. Now, before anyone panics, let me give you the other side of this story. Futures markets are designed this way. Most contracts are never intended for physical delivery. They're hedging instruments or speculative positions that get closed out before expiration. The fact that open interest exceeds physical inventory is completely normal and expected in a functioning futures market. So where does that leave us? Is the declining registered inventory a warning sign or just business as usual? Here's what we can say with certainty. The ratio of paper claims to physical metal has increased. Whether this increase represents growing risk or just reflects normal market operations depends on assumptions about how many contracts will actually stand for delivery. And that's where reasonable people disagree. Let me show you one more piece of data that adds context to this debate, the January delivery report. In January, we saw something unusual. A significant number of large commercial traders, the kind that typically hold short positions in silver, suddenly started covering those shorts. According to the Commitments of Traders report from the CFTC, commercial short positions decreased substantially in a very short time frame. Why does this matter? Commercial traders are usually the banks and dealers who provide liquidity to the market by taking the opposite side of speculative bets. When they aggressively cover short positions, it can indicate one of two things. Either they believe prices are heading higher and want to reduce exposure, or they're having difficulty maintaining those positions due to delivery or financing constraints. Again, interpretation varies. Optimistic analysts see this as smart positioning ahead of a rally. Skeptical analysts see this as potential evidence of delivery stress. What's not in dispute is that it happened, that it was significant, and that it coincided with the price volatility we discussed earlier. Now let's talk about something that doesn't get enough attention in mainstream financial media: the relationship between the US dollar and precious metals. Pull up a long-term chart of the dollar index, the DXY, which measures the dollar's strength against other major currencies. For over a decade, we've seen a general uptrend. The dollar has been strong relative to the euro, the yen, the pound. This strength has been one of the factors keeping precious metals prices in check, because when the dollar rises, dollar-denominated commodities typically fall. But something interesting happened recently. That long-term trend line, the one that's held for years, broke. In a matter of hours, not days or weeks, we saw a technical breakdown that chart analysts pay serious attention to. Does this mean the dollar is collapsing? No. Does it mean we're on the verge of hyperinflation? No. But it does suggest that the dynamics supporting dollar strength may be shifting. And if the dollar weakens, precious metals typically benefit. Here's why this matters to you personally. Even if you don't trade currencies or commodities, the dollar's purchasing power affects everything you buy. Your groceries, your gas, your ability to travel internationally, the real return on your savings. When the dollar weakens structurally, not just temporarily, it changes the calculation for how you should think about preserving wealth. Now, I want to address something that comes up in more conspiratorial corners of the internet. The idea that there's some kind of price suppression scheme, that powerful entities are deliberately keeping silver prices low. Let me be very clear about this. I cannot prove that such a scheme exists, and making that claim without evidence would be irresponsible. What I can tell you is that there have been documented cases of precious metals manipulation in the past. Major banks have paid fines for spoofing and manipulation in gold and silver markets. These aren't conspiracy theories. These are settled legal cases with public documentation. Does past manipulation mean current manipulation? Not necessarily. Markets can have a history of problems and still function properly after reforms. But it does mean we should look at market structure critically rather than assuming everything operates perfectly efficiently. The key question isn't whether bad actors exist. They do, in every market. The key question is whether current market structure allows for manipulation or whether it's fundamentally sound. Here's what we know about the current structure. The vast majority of silver trading happens in the paper markets, in futures and derivatives. The amount of physical silver that actually changes hands is a small fraction of the total trading volume. This creates a scenario where paper trading can potentially influence physical prices rather than physical supply and demand, setting the price for paper contracts. Is this problematic? Depends who you ask. Defenders of the current system argue that liquid paper markets are essential for price discovery and hedging. Critics argue that excessive paper trading divorced from physical fundamentals creates distortions. Both perspectives have merit, and I'm not here to tell you which one is absolutely correct. What I am here to tell you is that understanding these dynamics helps you make better financial decisions, regardless of which theory you subscribe to. And let me bring this back to something concrete. Central banks around the world have been net buyers of gold for over a decade now. According to the World Gold Council, central banks added over 1,000 tons of gold to their reserves last year alone. That's not conspiracy theory. That's public data from central banks themselves. Now, central banks aren't buying silver in the same way, but the principle matters. When the institutions that create fiat currency are accumulating hard assets, it tells you something about their confidence in the long-term stability of fiat currency systems. You don't need to be a gold bug or a dollar bear to notice this pattern and ask what it might mean for your own financial planning. Here's something else worth considering: the industrial demand side of the silver equation. According to the Silver Institute, roughly half of all silver demand comes from industrial applications. Solar panels alone consumed over 100 million ounces last year. Electric vehicle production uses silver. 5G infrastructure uses silver. Medical applications use silver. As the global economy continues transitioning toward green energy and advanced technology, industrial silver demand is projected to increase significantly over the next decade. Meanwhile, silver mine production is relatively inelastic. You can't just flip a switch and double silver output. New mines take years to develop and bring online. So we have rising industrial demand, flat to slightly declining mine production, and elevated investment demand all occurring simultaneously. Basic economics suggests this should lead to higher prices. Yet silver remains well below its inflation-adjusted peak from 40 years ago. This disconnect is what keeps analysts on both sides of the debate engaged. Either the market is correctly pricing in factors that offset the supply-demand imbalance, or the market is mispricing silver based on faulty assumptions or structural distortions. I don't claim to know which scenario is accurate. But I do know that understanding both possibilities puts you in a better position than just accepting one narrative uncritically. Let me give you one final data point before we move to the practical implications: the gold to silver ratio. This is the number of silver ounces it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 1 over long periods. Right now, we're around 85 to 1. What does that tell us? Either silver is undervalued relative to gold, or gold is overvalued relative to silver, or the historical relationship has fundamentally changed. Reasonable analysts disagree on which interpretation is correct, but the deviation from historical norms is mathematically verifiable. The point of walking through all this data isn't to overwhelm you. It's to show you that something genuinely unusual is happening in silver markets, that multiple interpretations exist. And that understanding the facts helps you navigate the uncertainty better than just listening to confident predictions from talking heads, who may or may not know what they're talking about. So now that we understand what's happening and why experts disagree about what it means, let's talk about what this might mean for your financial situation and how to think about precious metals in the context of overall financial planning. Let me start with something that might surprise you. I'm not going to tell you to buy silver. I'm not going to tell you that silver is guaranteed to hit any specific price target. And I'm definitely not going to tell you that precious metals should be your entire investment strategy. What I am going to do is help you think through the variables so you can make informed decisions based on your own situation, risk tolerance, and financial goals. Let's talk about valuation for a moment, because this is where things get really interesting and really controversial. Some analysts calculate what they call fair value for silver based on historical relationships with other assets, money supply, and inflation. One common methodology looks at the M2 money supply, which is a measure of dollars in circulation, and compares it to silver prices over time. When you run these calculations using inflation adjustments from the 1980s methodology, before the government changed how it measures inflation, you get some eye-opening numbers. According to these models, silver would need to trade somewhere between $150 and $250 per ounce just to reach historical equilibrium with the money supply. Now, is this a guarantee? Absolutely not. Is it interesting food for thought? Definitely. The counterargument is that historical relationships don't guarantee future outcomes, that modern financial markets operate differently than they did decades ago, and that alternative stores of value like digital assets have changed the dynamics of hard asset investing. Both perspectives deserve consideration. The truth is that fair value is subjective and depends entirely on which metrics you prioritize and which assumptions you make about future monetary policy, industrial demand, and investor behavior. Here's what you can control. Understanding the variables and deciding how much, if any, exposure to precious metals makes sense for your specific situation. Let me walk you through how financial advisors typically think about this. Conservative wealth management generally suggests that hard assets, including precious metals, should represent somewhere between 5 and 15% of a diversified portfolio. The exact percentage depends on factors like your age, income stability, risk tolerance, and existing assets. Why not more? Because precious metals don't generate cash flow. They don't pay dividends or interest. Their entire value proposition is price appreciation and insurance against currency debasement or financial system stress. Overallocating to any non-productive asset creates opportunity cost and increases portfolio volatility. So, if you're considering adding precious metals exposure, the first question isn't which metal or what price target. The first question is, what percentage of your overall wealth makes sense to allocate here, given your complete financial picture? Now let's talk about the practical mechanics, because this is where a lot of people get tripped up. You have essentially 3 ways to gain silver exposure: physical metal, exchange-traded products, and mining stocks. Each has completely different risk and return profiles. Physical silver means you actually own the metal. You can hold it, store it, and sell it whenever you want. The advantages are complete ownership and no counterparty risk. The disadvantages are storage costs, security concerns, and the fact that when you buy physical, you're paying a premium above spot price, and when you sell, you're receiving less than spot price. These bid-ask spreads can eat into returns significantly. If you go the physical route, shop around. Premiums vary widely between dealers. Understand the difference between spot price and what you'll actually pay, and factor in selling spreads when you're calculating potential returns. The $32 spot price might cost you $40 to buy and might only fetch you $30 when you sell, depending on market conditions. Exchange-traded products like SLV or PSLV give you paper exposure to silver prices without the hassle of physical storage. You can buy and sell instantly with tight spreads. The trade-off is counterparty risk. You're trusting the fund structure, the storage arrangements, and the financial institutions involved. For most people, this is perfectly fine. But if your entire thesis is distrust of financial institutions, then paper silver defeats the purpose. Mining stocks give you leveraged exposure. When silver prices rise, mining company profits can rise even faster, potentially leading to outsized stock returns. But the reverse is also true. And mining stocks come with company-specific risks that have nothing to do with silver prices. Management quality, operational issues, geopolitical risks in mining jurisdictions, all of these can impact your returns independent of where silver goes. There's no universally correct answer about which approach is best. It depends entirely on why you're buying silver in the first place. Are you looking for portfolio diversification? ETFs might make sense. Are you concerned about financial system stability? Physical might be your preference. Are you looking for growth potential and comfortable with higher risk? Mining stocks could be appropriate. Understanding your own motivation clarifies which implementation makes sense for you. Now, let's talk about something that doesn't get discussed enough: timing and volatility. Precious metals can be incredibly volatile in the short term, silver especially. It's not unusual to see 10 or 15% moves in a single week. If you're buying with money you might need next month or next year, you're setting yourself up for potential forced selling at losses. This is why most advisors recommend thinking about precious metals as a long-term holding, measured in years, not months. The people who get hurt in metals are usually the ones who jump in during euphoric rallies and then panic sell during corrections. If you decide to establish a position, consider doing it gradually rather than all at once. Dollar cost averaging into precious metals over 6 or 12 months reduces the risk of buying at a temporary top and gives you the benefit of averaging your entry price. Here's another practical consideration that matters: tax treatment. In the United States, physical precious metals are taxed as collectibles, which means a higher capital gains rate than stocks if you hold them for more than a year. ETFs may have different tax treatment depending on their structure. Mining stocks are taxed like regular stocks. These differences might seem minor, but they can significantly impact your after-tax returns over time. This is exactly the kind of detail you should discuss with your tax advisor before making moves. Let me address something I know some of you are thinking about. What if there really is a major monetary reset? What if the conspiracy theorists are right and everything changes dramatically? First, understand that major monetary changes, while rare, do happen. The end of the Bretton Woods gold standard in 1971 was a fundamental restructuring of the international monetary system. The creation of the euro was a massive monetary experiment. China's internationalization of the yuan represents an ongoing shift in global finance. Could we see another major change in our lifetime? It's possible. Central bank digital currencies, the evolution of reserve currency status, reforms to the international monetary system, these are all being actively discussed by serious policymakers. But here's the key insight. Even if major changes occur, they typically happen gradually with transition periods, not overnight catastrophes. And having some exposure to hard assets provides a hedge without requiring you to bet your entire financial future on a specific dramatic outcome. This is the difference between reasonable preparation and paranoia. Reasonable preparation means diversification, including some hard assets, while maintaining a balanced overall portfolio. Paranoia means putting everything into a single asset class because you're certain the system will collapse imminently. History shows us that the people who do best financially are not the ones who make extreme binary bets. They're the ones who understand risks, prepare accordingly, but don't let fear drive them into poorly diversified positions. Let's bring this back to that 3-price reality we started with. Whether you believe it signals system stress or just reflects normal market variations, the fact that it exists tells you something important. Physical assets and paper claims on those assets don't always trade at the same value. This matters for any hard asset, not just silver. Real estate, commodities, collectibles, all of these can show divergence between spot prices, futures prices, and actual transaction prices. Understanding this dynamic makes you a more sophisticated investor regardless of what you own. So what's the takeaway from everything we've covered today? Something unusual is happening in silver markets. The data is real, the price divergences are verifiable, and reasonable analysts disagree about what it means. This uncertainty is actually valuable information. It tells you that we're in a period where assumptions should be questioned and positions should be thoughtful rather than reflexive. If you currently own precious metals, understand why you own them and what conditions would cause you to reconsider. If you're thinking about buying, understand your motivation, size the position appropriately, and have realistic expectations about volatility and time horizon. If you have no interest in precious metals at all, that's also a completely valid choice as long as it's based on understanding the arguments rather than ignoring them. The goal isn't to convince you that any particular scenario will happen. The goal is to help you navigate uncertainty with better information and clearer thinking. Remember that vacation analogy from the beginning? The one where airline prices made no sense? Well, in the financial world, when prices don't make sense, it usually means one of two things. Either you don't understand the full picture or something fundamental is changing beneath the surface. Our job as investors isn't to be certain. It's to be curious, informed, and appropriately positioned for multiple possible outcomes. So here's my challenge to you. Don't just believe what I've told you today. Don't just believe what the silver bulls say. Don't just believe what the skeptics say. Look at the data yourself. Read the warehouse reports. Check the lease rates. Follow the central bank purchases. Form your own opinion based on evidence rather than emotion. Because at the end of the day, your financial future is your responsibility, not mine. Not some talking head on financial TV, not some guru on social media promising guaranteed returns. The good news? You now have the framework to understand what's happening, evaluate different perspectives, and make informed decisions. That's more than most people get from an hour of financial education. Whether silver goes to $50, stays at 30, or drops to 20, you'll understand the forces at work and be able to adjust accordingly. That's what financial literacy actually means. Not predicting the future, but understanding the present well enough to navigate whatever future arrives. And speaking of the future, remember those three prices from the beginning? $32 on your screen, 51 in Shanghai, 62 for physical delivery. That gap exists right now as I'm recording this. By the time you watch this video, those specific numbers will have changed, but the pattern, the divergence, the question of what it means, that remains. Keep watching, keep learning, keep thinking critically. And most importantly, keep making financial decisions based on your own situation rather than fear, hype, or the confident predictions of people who may or may not actually know what they're talking about. That's how you build real wealth. Not by chasing the next hot tip, but by understanding fundamental dynamics and positioning yourself thoughtfully for multiple possible futures. Thanks for sticking with me through this deep dive. If this video helped you understand the silver market situation better, let me know in the comments. And if you think I got something wrong or missed an important perspective, I want to hear that too. We're all learning together. Now, if you'll excuse me, I need to go check those three prices again and see what story they're telling today.